Shopify stocks are seeing a massive decline over the last year, and a lot of investors are feeling pain because of this. Well, Shopify is a big company, and Shopify's platform is increasingly becoming popular among people. However, it is still facing a massive decline. For those who don't know, Shopify is a Canadian multinational e-commerce company that is headquartered in Ottawa, Ontario. The company offers a proprietary e-commerce platform for online stores and retail point-of-sale systems. Let me tell you that Shopify platform offers online retail services such as payments, marketing, shopping, and customer engagement tools. In May 2021, the company reported that it had more than 1.7 million businesses in around 175 countries using its platform. Now, the question is, what is happening with Shopify stock? It is not because of the company's fault. Now, the question arises here, is the stock undervalued or there is still a buying opportunity at present?
Shopify has turned out to be an extraordinary platform, and I'm using again an index.
This variation of funds can be a great chance for the newcomers who are trying to get into Shopify. What's up guys? Welcome back to Glory Investing Show. In our today's video, I'm going to tell you what is happening with the stocks of Shopify in 2022, whether it is a time to buy, hold, or sell the stock.
A nice move up today as well. So what is the right valuation for a company like this, Steve, in this environment?
In a nutshell, what we are seeing is merely the rotation of funds in the market. Who would have supposed that companies like General Motors and Ford would come adjacent or set new 52-week highs given the supply chain issues we have seen in the marketplace? However, the companies such as Shopify, PayPal, and some others are under men's fire. Now, the major difference between these two groups is the value versus growth. The e-commerce king Shopify has the sturdy growth potential with backloaded projected profit profiles that are being traded off the most. The company has a great growth name, and because of the 10-year stepping bend, we're all seeing a sell-off across all growth tags. If you guys look at the prior year chart of Shopify, you will see some tags below. You can resemble this look to the late winter of 2021. Though rates outdid right about where we are today, there are numerous persons who think that they could head higher. What is leading this charge is the danger of rates being augmented that doesn't need to occur, but actually this is not good for stocks at all. Well, at least for the technology stocks like Shopify that is growing rapidly. Now, before we go any further, make sure you subscribe to Glory Investing Show and don't forget to hit that bell icon so you never miss any updates. The 10-year upsurging indicates the sturdier economic activity and mounting inflation anticipations. We're continuously seeing a wave of inflation, and that means this is more a sign we could lastly see some economic retrieval, and once again the increasing interest rates will also be included in it. The major issue with the growth of companies such as Shopify is that when the rates go higher, it means that there will be fewer future anticipated earnings than they were previously. A few of the technology companies are losing money in the short term, but the rest of the companies like Shopify are already lucrative. But the issue is, they are all investing presently to anticipate a greater profit ahead. Moreover, in the future, an earnings stream is predictable. The less valued it becomes compared with the yield on the benign asset, a treasury bond. Perceptibly, value names will not escape this also if it gets wicked enough, but the firmest hit will be the growth names. You're looking at the company that is going to propagate EBITDA by a minimum of more than 30% after 2022. We all can see the growth this year, but it is not as much as it was in the 2 years of the pandemic when the company got a huge benefit during the 2 years lockdown. The company is having a strong position in the market and its business model is also amazing. The good thing is Shopify is gaining market capitalization at an implausible rate as they are with the most market share in the United States e-commerce sales other than Amazon. Even Walmart, eBay, Apple, the Home Depot, and Best Buy are behind. As the company is going great, it will make a huge amount of cash flow that will be an option for the company to reinvest the amount, or there can be another option of buying back shares. I don't think that there will be a chance of a dividend at this stage, but Shopify has done an amazing job of using the cash to grow the company on a long-term basis, so why alter anything? According to my point of view, the downfall is not in the control of the company. The company has not modified whatsoever, basically that deserves the sell-off you have seen. Shopify has been punished for making a lot of progress due to its augmented rates. The stocks will ultimately be stable somewhere in the future and then they will continue forward from the point of stabilization. I remain optimistic about the company long term, but this does not include the market's current position. The last few months were not very great for the Shopify investors, as the stocks are down to almost 40% since its high at $1,762 during the month of November. From that month, we are seeing the downfall of the stocks. It may be too early to tell you guys that I think good vibes are coming given the recent support in place. We can see that the price of the share is very close to the fair value that it has been in a long time. This is inspiring, but the further downfall is still probable here. Let me make a start from where we find ourselves bouncing at present. $10.50 has been a tie of support before, and this is basically where we saw the bounce occur on January 21st. It is not flawless, and there were preceding 200 days moving regular support where the stock lately touched these levels. But seeing how tough the stock united off this level, it does look inspiring. I would like to see an additional test of this low and an optimistic bounce before feeling assured that the bottom is in. Until then, we could disrupt it and go even lower. If we break through $10.50, we can conveniently find our way down to $845. It will be shocking to see the stock getting down then to this level. Otherwise, it will put the stock to half price than its recent highs. We have lost 200 days on average, and it will take a few times to get back. The stock has not spent a protracted period of time below it since the year 2018. We could find ourselves here for some time. The variation in average is now a negative slope, and due to how quickly the sell-off has been, it is going to take a few times to correct again. But there is a progressive sign that we have seen a bottom in the comparative strength index. This is a decent pointer of if something is overbought or oversold. If we look, it is clearly in oversold terrain. However, it does not mean that it will jump to 30% in a week, but that the slumps may probably be in for now. We can either see a rally back up to what could be $12.75 in the future, or the stock trade slanting here for a bit in the short term. RSI is a decent sign for a very short-term move. So is the bottom in? Not yet, technically speaking. Despite the fact that it looks confident, it would not be including another situation here aside from assuming you have an extremely long haul sight. I would stand by to see the more extensive market begin to pivot and Shopify with it. Sit tight for a twofold base off at $10.50-ish and afterward hope to enter. I think it is somewhat too early now. Keep that capital benign. And that should be it for our today's video. So once again, if you like this video, smash that like button. Also, you can support the channel by clicking the subscribe button. And as you can see right now, these two videos are popping on your screen, so click on them and watch them to see what else we have to offer. Take care, stay tuned.